Hello, everybody. Ed Yardeni here. I'm out in my home office in Long Island. It's July 14th, and it's summertime, so quite hot here in New York. It's supposed to get hotter at the end of the week, but that's why they call it summer, and that's why they call it the dog days of summer sometimes. And the stock market certainly hasn't had any dog days so far. It's done extremely well. The question now is whether the escalation of Trump's trade war over the past few days is going to weigh in the market. And so far, it doesn't seem to be the case. Investors have been betting ever since April 9th, when the president postponed his Liberation Day tariffs. Ever since then, investors have been betting that he will turn out to be much more flexible on this issue, and that a lot of the extreme positions he takes are meant for the purpose of negotiating deals. Now, as you recall, Peter Navarro, back around Liberation Day, around early April, said that he wouldn't be surprised if they got 90 deals in 90 days. Well, so far they basically have two deals, so they haven't made a lot of progress, and the president's probably frustrated about that. I think the president also is pretty impressed with the ability of tariffs to generate revenues. Right now, in I guess it would be let's say March, April, May. Yeah, I think that's correct. Past 3 months, or the first 3 months of the tariff onslaught, he's brought in $88 billion. I actually have a chart of that, so I'll corroborate whether I got the months right in a minute. But $88 billion. So he figures if he annualizes that, he could bring in over $300 billion, and that would help to reduce the deficit. And I think he may be now thinking to himself, well, if I can get $300 billion with 10%, why not have a base tariff of 20% and get $600 billion? Well, I wouldn't be surprised if he's thinking along those lines, and one of the reasons I'm not surprised, wouldn't be surprised about that, because he's basically said so. I think it was last Sunday that he was on Fox Business show with Maria Bartiromo, and he basically said, sort of as an aside, that he's still thinking about maybe that the baseline would be 15 to 20%. $600 billion at an annual rate obviously would do a significant. It would have a significant impact on reducing the deficit. He also wants to reduce the deficit by lowering interest rates. He's frustrated because he can't do that on his own. So it's up to the Fed, and he's obviously been beating up on Fed Chair Jerome Powell on a daily basis now. So he's been talking tariffs on a daily basis. He's been talking about Powell on a daily basis, haranguing Powell that he hasn't been lowering interest rates. And every day we got some kind of new intrigue going on now. Powell's apparently let the budget go a little bit, not a little bit, but somewhat above what was anticipated for redecorating the Federal Reserve's headquarters. And so they're kind of using that as a possible source of attacking him for mismanagement and trying to get him fired. I don't really know if Trump really truly wants to have him fired. I mean, there could be another motivation here, and that is every time he beats up on Powell and raises questions about the prospects for the Fed remaining independent, it does seem to have an impact on the dollar. It depresses the dollar. Every time he kind of huffs and puffs about tariffs, that has tended to depress the dollar. And part of his game plan may very well be to depress the dollar. It's a pretty tough thing to do because the dollar is is a key global currency. It's still uh, has a lot of positives with regards to why it should remain a reserve currency, including the fact that we've got the world's largest capital markets and probably the safest capital markets, more secure capital markets. But he has indicated that over the years that he'd like to see a weaker dollar. The idea being depress spending on imports to encourage exports to bring more onshoring. So I think that beating up on Powell is kind of in tandem with it's kind of a wrestling tag team in terms of the tools he's using, and the other tool is the tariffs. Now, ever since April 9th, as I said, the uh, markets have been betting that Trump couldn't possibly mean what he's saying and that he will back off and there will be negotiations that lead to more moderation. And I think the markets are basically thinking that his goal is a 10% base tariff, which is what he has now. And then he's going to work out reciprocal tariffs, which haven't worked out as quickly as he'd like. Hence the movement of Liberation Day 1 to Liberation Day 2. Liberation Day 1 was April 2nd. It was postponed on April 9th to July 9th. And then a few days ago, over the past few days, it's basically been moved to August 1st. And that is being touted by the administration as a hard deadline, that there won't be any movement past that. Look, I think the administration knows that this whatever they do now, um, they can't afford to have a recession later this year going into next year. They've got to do everything they can to hold on to their thin majorities in the Senate and the House. And so I think they are scrambling to get this issue behind them in a way that they can declare victory. So I think that'll still be the case. It's just taking longer than Trump anticipated, and it's taken longer than I thought to see this issue put behind us. I thought by now, uh, as we got into July, we would get some deals, and Trump would continue to move in that direction. But instead, we have Liberation Day 2, and we'll see how that plays out. I really don't have a problem with the market's interpretation, though. I think that given where valuations are back to where they were before the correction around 22, valuations aren't cheap. I think the market increasingly should be and will be driven by earnings. And speaking of earnings, I think we've got some good ones ahead of us here in the second quarter. Earnings turned out to be much better in the first quarter than had been anticipated, uh, but guidance was down. If there was any guidance at all, a lot of companies said, we just can't tell you where this is all going to go, depending on how Trump's tariff war goes. And so as a result of that, the um, the guidance led to a substantial reduction in earnings expectations for the second quarter. Now, this is not unusual to see analysts start out too optimistic, and as they get closer to the reporting season, to see them lower their estimates. They get more winks and guidance from companies that aren't going to deliver, so we aren't all shocked the day of the report. But in this case, I think the lack of guidance, or the guidance of tariffs, were a negative rather than a positive, which should have been obvious to anyone. That kind of guidance undoubtedly led to a greater reduction in second quarter estimates than otherwise would have been the case. And now the estimates are so low that I think there's plenty of room for upside surprises in the second quarter as well. And we'll look at the charts in a minute. But it's interesting that analysts' consensus expectations on an annual basis for this year and next year, they've stopped falling. They've stabilized. They've gone sideways, which is an indication again that the analysts have gotten the word that this tariff trade war will be resolved uh, amicably to a large extent, and that it won't have any significant significant harm to corporate profitability. But again, much will depend on how Trump responds to all this. He obviously likes the revenues that are being raised, so why not go from 10 to 20%? That's something that we want to be cognizant of. Also, by the way, I haven't seen any news. Let me know on the Q&A if I just missed it or if it's happening now. But Trump's supposed to be talking about Russia today, and presumably he's pretty mad at Putin and has come to realize that maybe Putin can't be dealt with and negotiated with. And so clearly, by committing more Patriot missiles to Ukraine, Trump is demonstrating that he's trying to put pressure on Putin in the only way that he seems to know, which is uh, brute force, brute power, and using Patriots to protect Ukraine is obviously an important development since Trump for a while there looked like he was picking the wrong side, was picking the Russian side rather than the Ukrainian side. I know, but in some circles that's controversial. But let's skip that and move on here. So, with regards to what he might say today, it's conceivable that there'll be another shocker today, and that they'll say that he's going to impose some huge tariff on any country that buys oil from Russia, and that could include India. Clearly, it certainly would include China and other countries that have been customers for Russia ever since they attacked Ukraine, and that could complicate things. Because as we've seen just the past couple of days, there have been negotiations going on. The EU has been negotiating. The Mexicans have been negotiating. The Canadians have been negotiating. But now all of a sudden he's talking about August 1st and talking about the kind of reciprocal tariff levels that he was talking about during Liberation Day number one. So, it can certainly make your head spin. I'm trying to do the best I can to, to, to avoid making my head spin and helping you kind of sort all this out. Uh, so let's see how that plays out. And I guess we're going to hear about it today. Well, let's look at some charts here. Oh, by the way, I guess the conclusion of all this should always be a conclusion to long-winded discussions here, which I guess is what I've just done. But my conclusion is I'm sticking with 6,500 by year end. So I'm kind of agreeing with the market that this too shall pass. That it'll probably pass by the late summer, early fall. That is to say, all the tariff issue, and that the U.S. economy will remain resilient, that there could be a bit of an inflation pickup in the next few months, but it won't be anything really significant, and that earnings will continue to justify a higher level for the S&P 500, though not necessarily a higher PE multiple. Look, the market is kind of come around to the view we've had for a while. For the past 3 years, we said that this economy is resilient, and that it can tolerate a significant tightening of monetary policy. We've kind of viewed it as normalization of monetary policy, and that worked. And we've been arguing that the tariff issue would not push us into recession, and that seems to be working out so far. And I think one can argue that high valuation multiples, can be sustained the longer that investors believe that the economy can grow, that it can grow without falling into recession. And so maybe if we look at valuation multiples coming back to war before the correction obviously reflected another one of these recession scares, recession that didn't happen. And maybe the market's becoming cockier, more aggressive about the idea that maybe we won't have a recession for the rest of the decade. Maybe there's something to the idea of a roaring 2020s idea. And then, of course, there's the whole technology background about AI, and lots of stories that actually confirm that it might be the real deal, that it might really already be increasing productivity quite a bit. Of course, a lot of these stories are coming from the companies that stand to make the most if AI really catches on. So, Salesforce, Microsoft, other IT companies have raved about what it's capable of doing. But we'll see how that all goes. So chart-wise, and so far we got one question from Rich. If a few of others of you would like to join in for the Q&A part, send in your questions. Let's go here and share. Okay, let me get a swig of water here. Is Max here? I'm sorry, Max decided not to show up today. Okay, so July 14th, I think today's Bastille Day, actually. Um, the Fed has been saying that they are in no rush to lower rates. So they're clearly biased to lower rates. Trump is upset because they don't want to be, he doesn't want to see them biased to lower rates. He wants to see them actually lower rates. But I've been saying that, what's the point of lowering rates if, in fact, the current level of interest rates is consistent with nirvana. Nirvana being that the Fed's dual mandate of full employment and low inflation is being met at these levels of interest rates. I get a lot of pushback, obviously, that this number and that number suddenly looks weak. But labor market certainly looks still pretty good. The payroll numbers look pretty good. The work week was down. So all in all, the labor market story for June wasn't as strong as the payroll numbers showed. But then again, the resilience of the economy in the face of all this tariff turmoil is really pretty impressive. I mean, a lot of companies had a lot of incentive to just freeze hiring, to cut back. Consumers maybe as well, but that really just hasn't occurred. I know retail sales in May were down 0.9%, but the control group was actually up 0.4%. We'll see what the retail sales do later this week. It's hard to tell. It could be another one of these mixed stories. I know going to the malls locally here in Long Island, it's pretty hard to find a parking space. So my anecdotal evidence is the consumers are still spending. Um, so the unemployment rate here is 4.1%. That's full employment. That's pretty good. Kind of, it is a very cyclical variable, but usually when it goes up, it's because there's a financial crisis. Maybe this time it'll be a trade war crisis. It hasn't happened so far, and we're certainly testing that thesis. Um, Figure two, and of course, there's a lot of people talking about debt crises, dollar crises. The world's going to come to an end, yada, yada, yada. We've seen that kind of talk before. And so far, it hasn't happened. Overnight, we did have Japanese super long rates, 30, 40, 50-year, I don't know if they have a 50, but 30 and 40-year rates went up substantially on concerns of government spending over there. So, but that's kind of in the super long area. The 10-year still remains pretty low. Figure two, we've got the inflation rate is the CPI, take out rent. We've been doing this for a while, and it's been under 2% for a while, or at most it's been running around 2%. So that's pretty good. And historically, the CPI runs hotter than the PCED. Meanwhile, we could look at the misery index, and misery is pretty low. The average misery reading here, as you can see, is 9.0. That's the sum of the unemployment rate and the inflation rate, and we're well below that. So people shouldn't be miserable, though the confidence measures can constantly show us that they are miserable, but on the other hand, they are spending. And the labor market suggests that they shouldn't be as miserable as they claim to be. Stock market record high. Bonds have been kind of holding their own. We've been saying that the 10-year should be where it is, right around 4.5%. So that's where we are, and we think it continues to hang around there. Um, Not looking for a credit debacle anytime soon. We've said we'll worry about it when the bond market worries about it, and we were somewhat worried about it back here when the bond yield got up to well, actually, it was back here, right? 2023, the bond yield got up to 5%. And then they found plenty of buyers. There wasn't a buyer's strike up here. There was actually plenty of buyers at 5%. And didn't last very long, so it didn't have much of an economic impact. I'm sure if we saw 5% again, you'd find plenty of buyers for the 10-year. This is what I mentioned before, that Trump must be very delighted to look at the past 3 months. And this is the past 3 months through June, actually. So April, May, June. So I really meant May, June, April, May, June. April, May, June, I think I said that before. So that adds up to $88 billion. Multiply, that's a 3 month sum. Multiply that by four, you get over $300 billion. So that's pretty good, and that's with basically a 10% tariff rate with some additional tariffs on China. So I don't know if anybody at the Council of Economic Advisors, our good colleague and friend, went over to the Council of Economic Advisors, as I mentioned before, and he and I worked on this chart before, so it's pretty clear that if you can bring in $300 billion at 10%, you should be able to bring in $600 billion at 20%. So why not go all the way? And the answer is don't push your luck. At some point, you really do start to create some real economic damage. I know there's a lot of controversy about what tariffs are, but at the end of the day, it's a tax. It's a tax on the importers that have to pay the duties, and if the importers can pass some of that off to the consumers, then it's a tax on them. And if the importers can get a discount from their vendors overseas, then it's a tax on them. It's certainly not a positive for economic growth somewhere, unless it's muted at 10%. I think the world has already said that they'll let that one pass without much concern. But again, if you start talking about 20%, which Trump has mentioned, and you're trying to shoot for $600 billion, well, my goodness, that's bigger than what corporate taxes are. So that's something to kind of keep in mind. Meanwhile, on the good news front, it is the earnings season, and the numbers we look at look pretty upbeat. This is the analyst expectations for earnings for next year. They did lower them during the Trump tariff turmoil part one. We'll see what happens if this turns out to be another tumultuous development in the tariff war, or whether they're by August 1 things calm down. But you can see that the expectations have leveled out around $300 per share, which happens to be our forecast for next year. And then if you look at the 2025 estimate, it's also leveled out. Our number is 260. The analysts are around 263. So we kind of like what we're seeing here is consistent with our thinking of what earnings can be delivered. And then you take the time weighted average of these two and you get forward earnings. Forward earnings is converging towards the 2026 number by the end of the year. If this is still here, then forward earnings will be up at $300 a share, which is kind of what the market's expectations will be, or the analysts' expectations for earnings in 2026. And that, we think, is what the market discount will be discounting at the end of the year, $300 a share. Multiply that by 20 and you get 6,000, which is kind of where we are. Take those multiples up to 21, 22, 23, 24, 25, and you get some upside from the current level on the S&P 500. But the other thing you can do, of course, is continue to take earnings up in 2027. Once you get into 2026, we'll be looking at 2027. And so, we've been talking about the roaring 2020s. So far, so good. I think we can argue that it's worked out even to the present day, and that we might have another decade of this would be great for earnings. Meanwhile, this is forward operating earnings. Analyst consensus expectations is the same thing as this red line. Again, all-time record high. A pretty good coincidence, somewhat leading indicator of actual earnings. So that makes us think that the earnings environment is still really quite resilient, along with because the economy is resilient. This is the what is this? This should be revenues. Yeah, this is revenues. So revenues forward all-time record high. This is kind of rattles around, zigs and zags, but we think it'll sag to the upside, and which is pretty impressive when you consider that the tariff turmoil should be depressing global economic activity, but you're not seeing it in the analyst expectations for S&P 500 revenues, which obviously does include overseas activities. The profit margin on a forward basis actually just rose to a new record high, and that's with these taxes going up. Something's kind of screwy here, and maybe the Roaring 2020s scenario is working out better than we thought. Maybe the productivity is so awesome that it kind of offsets all this tariff huffing and puffing, and the taxation impact of tariffs so far, and companies are doing extremely well. So with that, let's take some questions here. And Rich, your question is kind of on the long side. Let me take the shorter ones first. Lucas, what are the GDP impacts of the capex expense passed on the BBB sector-wise? Industries, semis, and commercial infrastructure, real estate should be the winners. Yeah, we're actually working on that now. As far as I understand it, if you build a data center today, you can expense it today. So that should be quite a boost to capital spending. But give us a couple more days to really sort it all out, and we'll give you more on it. But it's certainly a positive for capital spending. Eva Hyatt, are you still of the view that Trump's Treasury will be financing itself through short-term T-bills rather than longer-term instruments? Eva, I don't know for sure, but we are going to probably find out at the end of the month. At the end of the month, we'll get the quarterly refunding statement, and then we'll see whether the Treasury, how the Treasury intends to fund its deficit, whether they up the T-bills. I think I think they very well might do that. So I'll be watching that. We should all be watching that. Thanks for that question. Ralph, it is in fact Bastille Day and also my birthday. Happy birthday, Ralph. Perhaps free coffee at La Médaille. Yeah, I should be able to pronounce that properly since my wife was French. But anyways, my good friend Cagdis, hi Ed. Timing wise, when do you think a correction in the S&P is likely between now and autumn before S&P head higher later in the year? And how much of a local correction is reasonable, do you think? It may be pretty hard to get a correction here. We tried it. Market gave it a best shot, but it was a correction from February 19th to April 8th. Again, on fears that this might all lead to a recession. We need some to scare the markets with a recession scare, and I'm not sure if we can't scare them anymore with Trump's tariffs, and they think that's going to basically end relatively well, then that's not going to do the trick. Maybe it's going to take some signs of an inflation scare here. The CPI on a year-over-year basis tomorrow is tracking at 3% on a year-over-year basis. That's up from 2.8%. I have to believe the markets are aware of that. That's the Cleveland Fed's inflation nowcasting, which is what we turn to look at these things. And by the way, July is tracking at 3% as well. So at least from a CPI perspective, we're not moving lower. We're not going down to 2%. We're kind of hovering here around 3%. Maybe it's just taken a while. I know that Eric's new boss, Steve Moran, just put out a study looking at the past few months and saying, hey, there's no sign at all that our tariffs are having any impact on inflation, particularly in terms of non-durable goods and durable goods. Um, and we'll see. We'll see. I mean, again, I'm looking for a new car, and car prices are pretty high, and they're going to go higher here, I think, in the new model year. I gotta believe that higher cost of steel, copper, aluminum is going to have an impact on appliances and some other areas of our economy. So let's see how that plays out. I know that the first round of tariffs under Trump 1.0, those tariffs had a tremendous impact on appliance prices, but other than that, they didn't really do all that much. So Cactus, when I have a hard feeling on this, I'll pass it along to everybody here. But I'm more thinking square root for the shape of the market here. We had a V-shaped rebound in the stock market, and now maybe kind of square roots on us, kind of goes sideways for a while with some volatility. Um, and then we get a year-end rally. But on the other hand, I'm two-handed on this issue, two-handed economist. On the other hand, it might be hard to get a correction during earnings season if, in fact, we get some actually positive guidance and better than expected earnings, which I think we might be able to get. And there might be a lot of hype and reality about how AI is boosting productivity. Uh, let's see, I'll take a couple more. Are the Trump administration economic data trustworthy? Yeah, I mean, the Trump administration is not, it's not, they haven't politicized the data processing end of what the government provides, so I don't think that's an issue. This is Brad, will the dominance of tech company earnings continue in the next 2 years? Short answer is, I think so, yes. Rich, sir, please don't forget about my question, okay? I got to go back to Rich. Okay, given the Treasury's increased issuance at the short end and larger deficits over the next 2 fiscal years, the reserves will likely drop below 3 trillion by late 2025 or early 2026. I presume you're talking about the Fed's reserves. Will this force the Fed to restart some form of QE to push the reserves back to an ample level? Let me just, yeah, I think it could do that, but my bottom line is I think that the Fed would rather not play that game anymore. I don't know if they're really going to have to do that for reserve maintenance purposes, but they might. And so that could bring in a buyer of treasuries. So could stablecoin. There's been a lot of talk about stablecoin, and stablecoin has to be backed by something solid like treasuries, and that might help. So a lot of moving parts here, a lot of interesting developments. We're trying to keep our heads here. I think we all are doing that. From what I gather, a lot of you have managed to make it through the first half of the year and without getting hurt too badly, and maybe confirming to the people you manage money for that the equity market is still where you want to be in the long run, and that's still my position. And that's my story, and I'm sticking to it. Well, thanks very much, everybody. Let's do this again next week.